Hello and welcome back to the MCF Education Series. My name is Hunter Nighbert and I'm a financial advisor and retirement planning specialist with MCF Advisors. We're in the heart of the third quarter, and that means we're going to talk about navigating market volatility. Why volatility? Well, for one, August is usually one of the more volatile months on record, and September historically is the worst performing from a stock market standpoint. But the bigger reason is that volatility in the stock market happens, and it's quite normal. I think a good comparison is to that of a passenger on a flight. If you fly on a commercial airline enough times, eventually you're going to experience flight turbulence. Sometimes it lasts for just a few seconds, and other times it can be more pronounced. But whenever it presents itself, that initial uncontrolled feeling of helplessness, doubt, and often fear is always there. In many ways, flight turbulence can offer an insight to how we should learn and deal with stock market volatility. There are many great ways to prepare you and your portfolio for future stock market shocks. But when you're already in the period of significant volatility, there's really not much you can do other than changing your mindset or reframing your mental perspective from at least negative to neutral. And that's where the flight turbulence analogy can help. If you want to travel from London to New York, then you're going to have to fly. Likewise, if you want to achieve any long-term financial goal, chances are you're going to have to invest some of your money. An 8-hour flight is invariably going to experience some degree of flight turbulence, and when it does, the brain can go haywire in relatively new flyers. Having had little or no experience of turbulence, all manner of thoughts enter your head, with the dreaded crash scenario being the worst. We've all been there. Over time, more experienced and frequent flyers tend to come to terms with what flight turbulence is, having encountered it more often, completed flights safely every time, and possibly gained an educated understanding of what turbulence is. Whether it is caused by wind, jet streams, or pockets of rising air, experienced flyers learn to place their automatic and emotional reaction to turbulence in check, replacing it with a more rational, informed response. Sometimes there are more factors to contribute to heightened fear when it comes to turbulence on a plane. External verbal and nonverbal indicators from other passengers on the plane also lead to increased anxiety of the situation at hand. I know I've been on a plane with a swift bounce in turbulence. A large group of passengers let out a gas, which generally leads to more worry than the drop itself. This is natural in some sense too. This external noise adds to the confusions and anxiety, which tend to heighten our emotions even more. There are countless examples of external noise that apply to investments and volatility anxiety just the same. That is until we hear that reassuring voice of the captain letting you know that all is okay and the plane is still on course for its destination. The short-term focused world that we live in offers no shortage of commotion and potential distractions from our long-term goals. TV programs, newspaper headlines accentuate the current market trends and can make it feel like they're here to stay. If you find yourself in this situation needing to talk to someone with broader perspective on market activities, I think speaking to a financial advisor certainly can help. If not, just remember to not get caught up in the noise around you and your objectives. To maintain your focus on long-term retirement objectives, you will need to overcome herd mentality. What is herd mentality? It is a tendency to adopt behaviors demonstrated by our peers. During volatile times, you'll probably see the herd making some knee-jerk reactions and abandoning their retirement investing strategy. Others will avoid investing entirely due to the ups and downs of the market. But before you think about following the crowd, you should know that investors with this mindset don't always get the best results. A recent study conducted by Dalbar reported that during the 20-year period ended on December 31st, 2012, the annualized return for the average equity investor lagged those of the S&P 500 by nearly 4% a year. In investing, one thing that can for sure bridge the gap between novice and experienced investors is historical data that educates us to get a better picture of what normal is. Since 1928, the average entry-year low in the S&P 500 was negative 10.9%. And the average high was 16.6. That is a spread of 27.5% from low to high. To simplify this even more, it means the average stock market swing is 27.5% annually, regardless of where it finishes for the year. I would guess that's even more than you realize. It's also important to note that 62 out of the 93 years the stock market has finished in positive return territory, and that's a pretty good track record over the long term. Investing with a long-term focus is still a powerful and effective way to prepare yourself financially for retirement. Considering the following example, $1,000 invested in the S&P 500 from 1985 to 2014 generated annual returns from negative 37% to positive 38%. But in this time frame, that amount of money grew to $25,028. But you can see the result of remaining focused on the long term and staying invested. Will you be able to maintain your focus and your long-term goals during times of market volatility? When the market is volatile, remember your investing time horizon is long-term. And if market conditions change, working with a financial professional can help you should you need to make adjustments to your plan portfolio. History has shown that trying to time the market can actually hurt your results. During downturns, it's not uncommon for investors who fear further declines to want to move their money out of the market. Unfortunately, these investors sometimes do so at the very worst times, such as near market lows. A hypothetical $1,000 investment in the S&P 500 from January 1st, 2009 to December 31st, 2018, excluding dividends, grew to $2,775 when invested for the entire period. But if you had missed investing during the 10 best days during that period, you would have cost yourself over $1,000. And if you had missed the best 30 days over those 10 years, you would have lost money from your original investment. Timing the market is not a sound strategy and usually costs you money in the end. What if I could tell you there's a way to ensure that buying more of your investments when prices are lower without having to predict the future? Well, it's true. It can be done through a process called dollar cost averaging. This is just a fancy name for the process of investing on a regular basis, like you can through your company's retirement plan. As you can see in this hypothetical example, by investing $50 from every paycheck, the investor automatically purchased more shares when the prices were low than when they were high. This has helped the investor realize the average purchase price that is below the average share price during that same period. Now that's a much more reliable way to buy low. Keeping invested in a long-term focus are not the only options to combat volatility. Regardless of your risk tolerance, constructing a portfolio with proper diversification is not only important for the returns of the portfolio, but is also a key component to limit volatility as well. Most people associate diversification with not putting all their eggs in one basket, which is the general idea. But true portfolio diversification is intentional exposure to each asset class. Each asset class carries unique characteristics that can limit exposures to any one market cycle or risk. Asset classes often perform slightly different than one another, so avoiding overconcentrations in a particular security or asset class is always a wise move. Jack Bogle, founder of Vanguard and one of the great investing leaders of our time, said this: "Your success in investing will depend in part on your character and guts, and in part on your ability to realize, at the height of ebullience and the depth of despair alike, that this too shall pass." In the past 15 years, we have been exposed to normal market volatility as well as economic and world events that have led to periods of intense market volatility. One thing is certain, it is highly likely it will happen again at some point, and how we prepare and react really can be the differentiator when we experience turbulence in our portfolio and lives. As your plan's retirement planning specialist, I'm here to help you develop achievable financial goals and a plan that can help you reach them. I can help you stay focused on your objectives through varying market cycles. It can be reassuring to have someone with experience on your side to talk through your concerns and validate any decisions that you're considering, or just bring a different perspective on the bumps in the air. If you found this information in this video useful, I would encourage you to share it with coworkers, friends, and family. Until next time, stay safe and healthy.